After learning of relationship between planning and controlling, next topic we have that in the chapter number 8, that is techniques of managerial control. This topic you may expect in the examination, that is 1 marks questions, 2 marks questions, and sometimes 4 marks questions they may supposed to ask. The techniques of managerial control can be classified into two broad categories, that is, one is traditional technique, second one modern technique. Here in traditional technique we have that various techniques are: first one, observation, or it can also call it as personal observation; second one, statistical report; and third technique in the traditional we have the break even analysis or break even point; fourth one, budgetary control; and coming to that second type of managerial technique is modern technique. In modern technique we have the different technique. First one, management information system, that is MIS. In examination they may supposed to ask expand MIS. Second technique, management audit; and third technique, return on investment, it is ROI. In examination they may ask expand ROI, that is return on investment. And fourth one, responsibility accounting. In this class we are going to supposed to learn only the traditional techniques of controlling. Modern techniques I'll explain in the next classes. Coming to the traditional technique, the traditional technique is a technique which are those which have been used by the companies for a long time now. This kind of technique used by all the types of companies from the long time now, and that means from that many years this kind of technique they are going to adapting in their activities or in their operation of business for to control that management. This technique have not become obsolete and are still being used by companies. Even this technique, it is a old technique, but at presently also many of the company they are going to adapting, they are going to using this traditional technique. In traditional technique we have the different technique, already I have explained. Once again we'll see that the personal observation, statistical reports, break even analysis, budgetary control. Let us discuss the various traditional technique in detail. First one, personal observation. The name only indicates personal observation. Let us learn. This is the most traditional method of control. Personal observation enables the manager to collect the first-hand information. The personal observation, it is also one of the oldest form of technique in the traditional technique. This observation technique, the manager can collect the first-hand information, that is primary information. It also creates psychological pressure on the employees to perform well, as they are aware that they are being observed personally on their job. That means can just understand here, this personal observation, it is one of the traditional technique. This technique which helps to the manager to collect the first-hand information or primary information, and also the worker what they are working, if they have that any mistakes or any problem while they are working, they can easily find out with the help of this technique, that is personal observation. And also this technique is a psychologically pressure for a worker, because while they are working it shows that or it identify the problem of the what they are work. And also even this technique personally they are going to they have that more pressure on them. This is called personal observation. And this kinds of technique, this is personal observation, it is not suitable for all kinds of organization. You can just see that in the image or picture, the manager is observing everything in organization, whether they are working or what. If they are not working, they are supposed to give some suggestions with the help of this personal observation. For the workers, it is a mental or a psychologically pressure. And second technique, we have the statistical reports. The statistical analysis in the form of average, percentages, ratios, correlations, etc. present useful information to the manager regarding the performance of the organization in various information or various areas. If the manager, if the company, they want to get the information or they want to know their performance of the organization, they are going to supposed to use this kind of technique, that is statistical report. With the help of the statistical report, they may get the information in the form of averages or in the form of percentages or in the form of ratios or in the form of correlation. With this, the management can easily find out or they can know that what is the position or what is the performance of the company in a different areas. This information we can present in the form of chart, graph, table, etc. This is called statistical report. This statistical report, we are representing our performance, our organization performance in the number. Next one, we have that break-even analysis. Break-even analysis is a technique used by the managers to study the relationship between cost, value and profit. The company, while they are producing a product, they are supposed to invest the cost or capital, and also what is the proportion of the cost occurred for a particular product, that is called value. And after that finished goods, if they have supposed to sell their products in the market, what is the margin of profit they are going to earn, they want to know. So if they want to know that what is the relationship between cost and value and profit, if they want to know, they are going to using the break-even analysis or break-even point technique. And this break-even analysis or break-even point, it determines the probable profit and losses at different levels of activity. The organization has taken the different activities or different operations over a period of time. They want to know that whether the profit or loss occurred over a period of time. So they are going to using this kind of technique or break-even analysis. With this, they can easily know that what is the relation between cost and value, or what is the margin of profit or loss they are going to earn over a period of time. You can just observe here. Here I have given that one graph. With this graph, you can easily identify that what is a break-even point. Here, fixed cost and total cost and revenue, that is cost and value. In between, they have that margin of profit. They have clearly shown as a break-even point. This point shows you that there is no profit, there is no losses. It is called break-even analysis. In examination, you can expect 2 marks question, or they may ask, give the meaning of break-even analysis or break-even point. They have that formula to calculate this analysis. The formula is break-even point or break-even analysis is equal to fixed asset or fixed cost divided by selling price per unit minus variable cost per unit, in a way that we are going to calculating the break-even analysis. And break-even analysis helps a firm in keeping a close check over the variable cost, determines the various level of activity in the firm, and also they are going to aim at what is the margin of the target profit they are going to earn over a period of time. It is called break-even analysis. And the last technique in the traditional technique, we have the budgetary control. The budgetary control is a technique of managerial control in which all operations are planned in advance in the form of budget and actual results are compared with a budgetary standard. In an organization, they want to prepare a budget. That means before they want to decide in advance what is the amount may occur over a period of time. That means in a year, what is the amount it required to carry the business activities. They are going to deciding in advance. They are going to know that what is the expenditure and what is the revenue they may earn over a period of time. After that, finish that over a period of time, they are going to comparing that the actual performance with a standard budget. It is called budgetary control. This comparison, it gives the result of necessary action to be taken so that organization objectives are accomplished. If that the result it shows that positive result, it may the organization they achieve that organizational goals. If they have shown that negative result, the organization has to focus more to work and they want to take necessary action to improve that profit, or they want to achieve that organizational goal with effectively and efficiently. This budgetary control, it is a quantitative statement. Quantitative means it is a number, it expressed in numbers. Quantitative statement for a defined future period of time for the purpose of obtaining that objective. We are setting this budget in the terms of numbers. It gives that result regarding to the future. After that, when coming to the future, you are going to supposed to look backward what I have set at the standard, what may occur in a present. You are going to just compare that present and past. And also this statement which reflects the policy of that particular period. Even the budgetary control having that different objectives, that is first one, budget or budgeting focuses on specific time bound target, the organizational objective, and this budgeting control it motivating or motivation to employees who know the standard against which their performance will be appraised. And also the budgetary control, it may helps to use that optimum utilization of resources. And also one of the main objective of budgetary control is it helps to coordination among the employees various department in an organization. These are all the budgetary control. Even we have the different kinds of budget, like example sales budget, production budget, material budget, cash budget, capital budget, research and development budget. These are the types of budget in an organization. In examination, they may ask, state any one type of budget. With this, I am going to completing the traditional technique. Next class, I am going to explain you the modern technique. Thank you.